Hi there, I'm Zhang, Co-Portfolio Manager at Barrow Hanley Emerging Market Fund. And today I would just like to take a few minutes to share with you some of the recent regulatory developments in China and their implications. Investing in today's global markets carry many risks. And recently, regulatory risk is becoming front and center focus for many investors as China introduced a host of restrictive policies targeting its internet and high-growth sectors. The reset started in last November when the regulator pulled Ant Financial's IPO, which would have been the biggest IPO in history. Then the government introduced a host of anti-monopoly measures targeting the internet and high-growth and fintech areas, causing many of these tech leaders like Tencent and Baba to sell 50% off from their peak. And most recently in July, the regulation tightening continued with heavy scrutiny on DiDi's data security right after its $4 billion US IPO. And today, DiDi's price is trading at 50% off from its peak. And then most dramatically, last month, the government decided to crack down on the highly profitable education sector in China, wiping out almost 80% in this $100 billion industry. So with all this volatility in the market, it's a very difficult and confusing time for many investors. While it's difficult to fully understand the government's intention, we do think the objective is becoming clear, and that is for the state to assert a much stronger control over the technology sector and its economy. The goal is to ensure stability in China as the country is faced with increased challenges in the coming decade. And these challenges include a slowing GDP growth, rise in income equality, aging demographic, and a much more combative relationship with the West. After a decade of high growth since the global financial crisis, how to translate its future growth and balance that with sustainability and quality. And that means increased social equality, environmental sustainability, data security for its citizens, and self-sufficiency in technology. Here in Barrow Hanley, we've been underweighing most of those Chinese internet and growth names in the past due to both high valuation and precisely these unquantifiable risks. But as the ancient philosopher Sensei once said, chaos also spells opportunity. At the Emerging Market Fund, we're actually looking for value opportunities where the investment thesis is more in line with government's long-term objectives. And these include new energy focus, self-sufficiency in the high-tech area, or even domestic brands for mass consumption. So in closing, despite all the recent market volatility caused by all these heavy regulatory reset, China remains attractive markets for investors in the long term as the country transitions to a much more sustainable growth model. And here at Barrow Hanley, we will stick to our bottom-up value approach by finding companies with strong balance sheet, good cash flow generation, and positive ESG considerations so we can continue to deliver results for our clients in the long term.